Welcome back to the channel. My name is Steven. I'm a pharmacist. I own 52 units of real estate and I help coach people to buy their first multifamily deal. So today I want to talk about how the wealthy legally avoid taxes and how they lower their tax liability when they file their taxes every year. So when you're a W-2 employee like myself, we have very minimal tax write-offs, right? So we have the standard deduction. I might have the 401k if you do the pre-tax 401k. That's really the only tax credits breaks that you'll get. And on top of that, your tax brackets are higher. So if you make a good income, sometimes your tax rate, especially in California, is about 40 to 50% depending on your income. So, because of that, that's why a lot of people invest in things that the tax code incentivizes. So a lot of things are like real estate is incentivized by the tax code. Owning a business is incentivized by the tax code. Investing in oil wells or oil is incentivized by the tax code. So they give you a lot of these benefits, right? If you own a nonprofit charity, those are heavily tax favorable as well, right? That's why a lot of rich people own family foundations as a way to legally avoid a lot of the taxes. So let's talk about some of these. So the first one is real estate, which is what I went into, right? So when you own real estate, obviously you have a Schedule A on your tax return. So this is a primary residence. You can write off, I think, up to $10,000. You can write off your property tax. You can write off some of the mortgage interest that you pay, but caps at $10,000, right? So if you live in California like myself, just my property tax alone is above $10,000, so I can only write that off. But we'll see with the new SALT tax increasing to $40,000. I'm not sure if I could write off more of my interest. So we'll see. I'm not educated enough about that, but I guess I'll see when I file my taxes. Or if you know, let me know. But basically, when you start owning a primary residence, obviously you get some tax benefits, but just know that it's expensive to own a home too, right? Because I pay $7,500 a month all in for everything: my HOA, property tax, mortgage, insurance, utilities, right? That's how much we pay. That's expensive. It's obviously cheaper to just rent a place where we'd probably pay only maybe half that, especially here in Los Angeles. It's something to consider, right? But once you start owning rental real estate, you get some tax write-offs as well, right? So once you start owning real estate, you can depreciate your real estate. So you can, when you buy a house, it's the price, let's say it's $1 million. It's broken into two pieces. Let's say $500,000 is the land and the $500,000 is the structure. So you can only depreciate the structure, and you can depreciate that over 27 and a half years, I believe. So you just take $500,000, divide that by 27.5 years, and then whatever that is on a monthly basis, you can write that off as passive losses, right? So that's what a lot of people do in real estate. So, but once again, if you make too much, I think if you make over 150K, which I do, these passive losses do not offset my W-2 income, so it just carries forward and offsets other passive income, right? So where real estate starts to get really powerful is if you become a real estate professional status, which is very, very hard to qualify for. So you have to, I think, work in a real estate profession more hours than your W-2 job. So if I work in my W-2 job, let's say 10 hours a week, I have to do real estate at least more than 10 hours per week. And it's really hard to qualify for this because you have to materially participate in properties. So what a lot of people do is they do short-term rentals that they manage themselves because you can materially participate, which can then help you, number one, qualify as real estate professional status. But number two is if you can materially participate, you could use your, convert your depreciation into active losses to offset your active income. So I'll give an example. So to be a real estate professional status, let's say me and Christine, we're both pharmacists, right? If I'm working full-time, I don't qualify as real estate professional status. But if Christine, let's say, works part-time 10 hours a week, and she became a real estate agent, and she sold real estate for 20 hours a week, and she was actively managing some of our rentals ourselves, then she can claim real estate professional status. So together, we file jointly, we both qualify together as real estate professional status. So if let's say I make $200,000 that year, but I have $200,000 in depreciation losses from real estate, I can basically pay $0 in taxes. So when I file my taxes, Uncle Sam will give me a nice check because I pay, let's say 40%, let's for easy math, 50% tax rate. So when I file my taxes, I would get about $100,000 back at the end of the year, tax free. right? So that's one way to do it. But like I said earlier, it's really hard to qualify for real estate professional status. You have to become a real estate agent, and you have to actively manage your rentals and document your hours. So it's very difficult, right? But it is a nice way to do that if you do qualify, because you can accelerate, depreciate your property. So there's something called cost segregation study, where you could accelerate the depreciation 100% year one. So let's just say I bought $1 million property, and let's just say $500,000 was structure. I can bonus accelerate depreciate, let's say $300,000 of that. Roughly, it's about 30% of your purchase price, which is $300,000, and I can wipe out my $30,000 salary, right, and pay zero taxes on that. So that's what people are doing, and that's what the new tax, I think the big beautiful bill now allows, 100% bonus depreciation, so you can do a cost seg, depreciate 100% year one, right? So that's how people pay zero taxes. Another way is material participation. So that's why Airbnb short-term rentals is a very popular strategy, where let's say you buy a house and you put a down payment and you're treating it like a short-term rental for, let's say, the first 6 to 12 months, right? So you get it fully furnished, you'll list it on Airbnb, you'll have tenants that stay there on a short-term basis, less than 1 week, less than 7 days at a time, and you're actively managing it. Maybe you're cleaning it, you're hiring a cleaner, or you're cleaning it yourself. And then at that point, you can claim that you have material participation, so that if you can do a cost segregation study, 100% bonus depreciate it as a active loss, and then you can wipe it off against your active income. So in this situation, me and Christine could both be working full-time as a pharmacist, right? But we own a short-term rental that we manage ourselves for 6 to 12 months, right? So we can document our hours that we put in the most work. We're actively participating in this, materially participating in this. We can do a cost segregation study on that and use that to wipe off our W-2 income. So let's just say we buy a house that's $1 million. We put $200,000 or $300,000 down. And then, I do a cost segregation study. I can write off $300,000 against our active income. So let's say we make $400,000. We can wipe off $300,000 of income, active income, assuming a 50% tax rate. That's $150K back that we get back in our wallets. So basically got back half my down payment if I put $300,000 down, right? Got back half my down payment tax free. So I only put $150 in the deal. And then what we do is we legitimately run it for about 6 to 12 months, fully furnished. You can document the hours of furnishing it. You can document the hours of cleaning it up. You can document the hours of decorating it. You can document the hours of driving there. You can document the hours of buying, decorations and furniture for that. And then you can do a cost segregation study, which costs a couple $1,000. And then now you can do a 100% bonus depreciation to wipe out your income. And then after a year, because Airbnbs are hard to manage long-term, if I'm being honest, and not scalable, you convert it to a long-term rental, right? And now you just have a long-term tenant, and hopefully you break even that property. So that's the hard part now, right? You have to buy an Airbnb, run it as an Airbnb for 6 to 12 months to claim your 100% bonus depreciation against your active income. And then after a year, you just convert it to a long-term rental. And at that point, it's just all passive losses now, right? So that's kind of a hack that maybe Christine and I might consider doing. But Airbnb is hard, right? Like you have to make it a good experience. So you have to be okay, like probably taking losses, or you have to put a large enough down payment that, you're not taking that large of a hit, right? So when you do this strategy, it has to work as both a long-term rental and a short-term rental for the short term. So it has to work as a short-term rental for 6 to 12 months. Like if you just can break even on the property, that's good enough. And then when you do a long-term rental, you have to break even once again. But like I say, if you live in California, you're putting a larger down payment, right? Like on the house I'm living in, I could make this a short-term rental, right? But when I treat it as a long-term rental, it's not going to work, right? So maybe something I could do is I could treat this as a short-term rental. Let's say I move out of this property, rent a place, convert this into an Airbnb, treat it as a short-term rental for 6 to 12 months. I could do a cost segregation on the house, right? And then I can bonus depreciate it and wipe off our active income. And then after doing that for about 6 to 12 months, I can then, move back into the house and then, treat it back as a primary residence, right? So that's a way that I could do it too, where I just could, Airbnb this out and maybe hopefully break even, or probably realistically lose money, and then do that. So that's another way that you could do that. But like I said, it's a pretty hard model as well. Like, it's not easy. So another way that you could, save money on taxes is if you own your own business, right? So if you own an S corporation, or even owning your own small little side hustle, right? Like for me, I do real estate coaching and consulting on the side as a little side hustle. And what's nice is, I can host events at my house, and then I could claim that, hey, I am renting my house. My business is renting my house for $200 a day, which is market rate, or $300 a day, whatever it costs to rent a hotel room in LA, which is about $200 to $300, to host an event to teach other people about real estate, right? So now if I'm making, and you can do it up to 14 days. I think it's Augusta rule. So let's just say I do it for 10 days for $200 each. That's $2,000 that I could have my business pay myself, and it's tax free, right? Or you can claim your home office deduction. So like you can, let's say your home office takes 10% of your house, then you can claim up to 10% of write-offs of all your expenses of your house. So, if I pay, let's just do it easy math, $50,000 a year towards my house, right? Between my mortgage, my property tax, my insurance, my utilities, my HOA, all that stuff, I can write off 10% of that, because 10% is my home office. That's $5,000 that I can write off against my income from my small business, right? So it's another tax write-off for things I'm already paying for, right? And another thing you can write off too is like, if you like travel related to your business. So let's say I'm meeting with a bunch of investors on Friday in Vegas. So I drive there, I can write off my miles. I'm staying in a hotel, I can write off the hotel. And then let's just say I'm meeting investors on Friday, then I'm meeting investors on Monday and Tuesday next week. So because I'm staying over on the weekend, I can write off all 5 days in my stay in Vegas of the hotel to be there. But in reality, on Saturday, Sunday, maybe I'm just going to clubs, maybe I'm going to partying, right? But it doesn't matter because it's incidental. Like, so I'm staying there on let's say Friday, doing work, doing business related activities, staying there Saturday, Sunday incidentally, because I have to meet more clients on Monday and Tuesday, right? And then so that way you can encompass the weekend. But let's just say I just stay there Thursday, Friday, but I don't have any business on Monday, but I stay on the weekend, I can write off, Thursday, Friday, can't write off the weekend because, it's just fun. That's fun for me. But if I have business on Monday, then I can write off the whole, 5 days of hotels. So you don't get that when you work in a W-2, right? Like I can't write off like travel or mileage. So you get more, tax advantages if you, own real estate, you're a real estate professional status, you mature participate in real estate. That's great ways to get tax benefits. If you own your own business, whether it's an LLC, sole prop, or S Corp, you get a lot more tax write-offs, right? Like you said, I can write off, 10% from my home office deduction. I can write off mileage. Like if I drive to meet a client, I can write off the mileage, right? If I drive to work, I can't write off any of the mileage. And then another kind of tax advantage is if you like invest in oil wells, which is something that I've been kind of researching recently. So with oil wells, let's just say you put $100,000 to, be a part owner of an oil well, it's actually considered active depreciation. So if I can write off, I think about 90% of the oil well, so that's $90,000 year one. So basically imagine I put $100,000 into an active oil well that I part own, and I can write off $90,000 year one, which would give me, let's just say, a $30,000 tax refund. And then ideally the oil well should be producing, monthly or quarterly income for you. And then hopefully the price of oil is going up as well on top of that. So that's a three-pronged way to do that. And what's beautiful about that is it's easier to qualify for, right? Like you don't have to document your hours for a real estate professional. You have to material participate in a piece of real estate. So that's something that, we can do. Like we can definitely do something like this, right? And something that I'm considering. But the hard part is finding a good oil well operator to invest with, right? That's the hard part, right? Like I'm trying to figure out yourself. If you know anyone, let me know in the comments. Interested to research more, but it's a great way right now because I don't want to be a real estate professional status right now. I don't want to actively manage an Airbnb right now, but I want tax benefits. So, the oil well is another way to do that. So, and then the last one it is like a charity. So what a lot of people do is, a lot of rich people, they own a family foundation where they have a charity. Like, Stephen Curry, he owns a charity. So, and he makes like $70 million a year from his MBA salary, probably another $100 million from his endorsements or whatever. So he will donate a lot of the money to his charitable trust. And then what he does is, who runs the charitable trust? Usually your family members, right? So you're paying them a nice salary. And then they can donate to certain things, right? Like whether it's building more basketball courts, maybe that's building more oil wells or whatever. Or so this is what rich people do. They're funneling into like these charitable trusts. and they're actually doing something, questionable how much they actually contribute, but they're doing something, quote unquote. But it's a way to shelter a lot of the money that they have and that they own, right? You could argue that, I'm hosting an event to educate kids, right? And then you get a huge tax write-off on that. So that's a more advanced version. I'm not even at that level yet. Maybe I'll get there one day, but that's another big way that people avoid a lot of taxes. So kind of in summary, if it's a TLDR, is when you work a W-2, you don't get much tax write-offs, right? You can write off your 401k. You could write off, basic, like maybe your home. But once you start owning real estate and you become a real estate professional status, you actively participate, you own your own LLC or S Corp, you own your own charity, you start investing in oil wells, that's when the tax benefits really start to kick in. And then if you look at like capital gains tax, so like I want to hit on this point too, capital gains tax at the most is like 20%. My tax bracket right now, it's about 35 to 40%. So like literally I can just live off my dividend income from my stock portfolio, and at most I'll get is taxed 20%, right? And that's if you're over $500,000. Like for the first like 100,000, it's like 0% tax. For 100,000 to $500,000, it's like 10% tax. So like realistically, I'm in the 10% tax bracket if I live off my dividend income. Versus my W-2 income, if I made $500,000, you're paying 50% in taxes. So that's what I'm saying. The tax code is incentivizing you to own real estate, to own a business, to own a business, invest in oil wells. They're incentivizing you for certain things to do, not incentivizing you to work a W-2, right? So anyways, hopefully you found some value. Hopefully you learned some few tax tips from me. Otherwise, if you have any questions, please like, comment, subscribe, put your questions down below. If you want one-on-one coaching to buy your first multifamily deal, click my link tree down below. From there, you can click on my link. Otherwise, hope to see you next one. Thank you so much.